Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Our next Family Office Summit is on November 20th in New York. It will feature Jose Minaya, Global Head of Investments and Wealth at BNY, and former podcast guest Ken Kensell, President and CEO of Churchill Asset Management. Please subscribe to circulus.substack.com to stay in the loop. Today's guest is Shirl Penney, founder and CEO of Dynasty Partners, which is a comprehensive platform that allows wealth advisors to go independent and form their own RIA. Shirl's story starts with a thrift store suit and a bus ticket and leads to the helm of this billion-dollar firm. We start off talking about the inefficiencies and economics of horse racing, Shirl's passion outside of work. We then go through the formation story of Dynasty post-GFC, their early challenges with technology and data, what the decision is like for a team to break out and start their own firm, their M&A advisory business, and the current hot market for RIAs. Shirl Penney is the founder, CEO, and member of the board of directors of Dynasty Financial Partners, one of the leading advocates and platforms for independent wealth advisor firms. Since its launch in 2010, Dynasty has grown to support more than 500 financial advisors across 55 independent firms that collectively manage more than $120 billion in assets. Prior to Dynasty, Shirl worked at Citi Smith Barney in various leadership roles, including Director of Private Wealth Management and Head of Executive Financial Services. Shirl is from Eastport, Maine, and graduated from Bates College. Please enjoy my interview with Shirl Penney.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
One of the things I was told when I started family office investing was to never buy a horse. The horses and film, stay out of film. But I would love to hear about how the racing world works from an entrepreneur's perspective. Maybe you could tell us how the process of selecting a racehorse works.
Look, from my standpoint, I'm so busy with work and family, I don't have a lot of time left to prioritize friends. And one of the greatest returns I've got from thoroughbred racehorses is getting all of my friends and family together for the races. It's not be surprising to see us have 50, 60, in some cases, 100 people at a race. And I always like to give a toast either the night before or the morning of with coffee instead of a drink that we've won before the gate is even opened, right? Because we all get to be together. And so the social return has been significant for us with racing. But I'm very intellectually curious about the pedigree, and I've gotten pretty involved in the sport over the last 20 plus years. We've owned a few hundred horses. When I went to college at Bates College up in Maine, I played baseball, and we would love to go as a team to the track. And some of the teammates enjoyed the gambling side of it. For me, I just love the horses, just love being around them, and they're beautiful, incredible animals, and said someday if I can afford it, I wanted to buy one. And so we started our stable 22, 23 years ago now. And so the process is we typically deploy a bloodstock agent who will help give us advice on the bloodstock, on the pedigree side. We also have advisors that help us look at the physical side of the horse as well. We have veterinarians that will vet the horse to make sure that no significant seen or known health related issues. And then the horse goes through the ring, and you try to have a disciplined budget process. And there's a lot of billionaires in that game that if they want a horse, they're going to get it. But we'll typically, if there's a couple hundred horses, like this weekend, there were a few hundred horses for sale in Saratoga. And we bought a colt that we like a lot and put together a whole team, including some trainers. We work with Hall of Fame trainers like Bill Mott. Anyone who follows racing would know names like Bill Mott, Todd Pletcher, some of the top trainers. And the jockeys are guys like Irad Ortiz, his brother Jose Ortiz, Hall of Famer Johnny Velasquez. Been doing this for long enough that it's a small community. And so we've been able, just like business, anything that you do on the horse side, it's really about the team that you put together. Make sure that high integrity people, they tell you the truth, sometimes even when it's not what you want to hear, and make sure that team's over communicating and everyone is able to do their job whether it's selecting the horse, developing the horse, training the horse, riding the horse, caring for the horse, that you get the best team together. And like all facets of life, Joe, the best teams are usually the ones that win over the long run.
Have you ever claimed a horse?
I have. That's not a big focus for us. We have a small pool of capital that we put together with some friends, including Jason Worth, who was World Series champion for the Phillies. There's a lot of interesting characters that have come together for a love of the horses in the game. But I'll partner with friends and we'll claim horses. But that's not usually my focus. Is breeding. So again, we have mares, and we're now into the third generation on breeding some of our horses, and we'll buy them usually as babies. We don't necessarily like buying them as much out of the 2-year-old sales because they get sometimes asked to run sooner than what maybe they want to run at those sales. So we like to develop our own horses either by breeding them or buying them, and we baby them. In full candor, we take really good care of them and spare no expense to make sure they're happy to be in a position to do their best on the track. So the claiming game is really good for the track because it ensures that there's fair and equal competition, because the track wants there to be no heavy favorites in a race, because that's what increases the betting. We don't play that game too much. We're trying to race at the higher levels and win stake races with our horses over time. And we've won some big ones. We won the second leg of the Philly Triple Crown, the Black-Eyed Susan, with actually a New York bred, a horse named Sweet Vendetta. We've had some homebreds that have won graded stake races. We've won stake races all over the country. And those are, getting back to what I said at the onset about racing, those are some of our great family memories of just getting in the car sometimes, long road trips, getting all of our friends together, and whether we won or lost, we always had a good time. Admittedly, we had a better time when we did win, but the kids will remember ever since they were babies now and beyond this great family time where we're going up to Toronto, to Woodbine or Arlington before it was knocked down in Chicago, or road trips to Florida or West Virginia or Kentucky and all through New York, where frequently on a weekend you could find our family and friends together cheering on one of our horses. So it's just been a lot of fun for us.
How is the horse owned? Is it like an SPV? Do you think in terms of a portfolio of horses?
Yeah, you would think of it in terms of a portfolio. The horse is typically owned in an LLC. And you, like any LLC, you can have multiple members. We don't run a syndicate, but we do run a partnership, because we have a lot of friends who'll come to us and say, hey, can I buy 10% or 20% of a horse the next time you're picking one out? And there are a lot of commercial syndicates that are in the space that will charge fees to have people enter into the partnerships. We don't do that. This is just our friends that are, think of it more of as a club investment. I wouldn't say it's old school merchant banking, but structurally, I guess it would be similar. And we split expenses, and then we split all the revenue from the purse money. And then ultimately, when we sell the horse for breeding or for whatever it might be at the end of the racing career, we split the proceeds pro rata. The LLC structure obviously provides some form of protection. It also makes it easier from an accounting standpoint. You might have a vintage where you say, this year we're going to go buy 5 horses, and it's whatever the investor puts money in gets their pro rata interest. I mentioned Jason Worth. He started a new venture called Icon Racing. I think his first fund, he raised $3 million. This year he's raising $5 million. And he'll go out and buy 10, 12 horses. And it's a great way for someone to come in. He sells his shares at $100,000 a share, and then they just split everything pro rata. And it's great for someone who wants some action and be involved in the game and get a little piece of a diversified pool of horses, as opposed to a lot of owners, which we do as well. We'll go out and buy a horse, just us, and we may have no partners on it. And in other cases, we might own 25, 50% or more of a horse. It's really, for us, really, Joe, more of a function of if one of our friends wants to buy in on a horse that they see us purchase at a sale. We've had some good ones. Sweet Vendetta, I mentioned, won the Black-Eyed Susan. We bought her at auction as a baby for $30,000. We won multiple hundreds of thousands on the track and sold her for close to $1 million as a broodmare prospect. I've had friends that have bought stallions when they're babies for a couple $100,000 and sold them for tens of millions at the end of their career to go become stallions. If you think about some of these top stallions today get $250,000, $300,000 per breeding, but they'll breed 200 mares a year. So 200,000 times 200, right? It's 40 million of revenue. And if the babies run, they could do that for 10, 12 plus years in a row. There was a stallion not too long ago named Stormcat. His stud fee was 500,000 and he produced incredibly well for a long period of time. He literally generated for his farm over $1 billion in revenue. And then his babies went on to become stallions themselves. So just there's an incredible amount of wealth around the industry, I think, that a lot of people don't realize.
The racehorse world isn't necessarily an efficient market. I'm wondering what kind of things you've picked up over the years to give you an edge.
Yeah, it's definitely not an efficient market. And the more relationships that you have with the farms, how these babies are raised matters, right? The farms that have modern technology in terms of how they care for the horses, that have quality vets and feed and just infrastructure, that does make a difference. The more experienced the developers are of the horses, quality of training that they receive, all of that ties into the development of the horse as well as the pedigree. And sometimes being able to get access, it's kind of, you take an elite stallion like a Curlin, who was one of the greatest racehorses himself, but now is equally an incredible stallion. He would be like a hot IPO stock or a private investment right now in a hot AI name that you want access to and it's hard to get. He's limited to only 150 or so breedings a year. And there might be 6, 7, 800 owners that want to get access, but won't be able to, which obviously can drive up bidding on what someone's willing to pay for a season to him. But if you have those relationships, sometimes that can help you get access in the horse industry, just like it can in any other industry as well.
So I'm curious about your career at Smith Barney. I used to work at Citi, and it's an impressive firm, but it had been stitched together from a dozen different companies, and it was very bureaucratic. And I was wondering if your experience there influenced what you went on to do.
Oh, I think most definitely in a lot of ways, the experience I had there influenced the founding of Dynasty Financial Partners. And I will say the culture, I started in Smith Barney, which obviously ultimately became part of Citigroup. And to your point, a lot of different businesses, obviously under Sandy Weill's leadership back in the day, were brought together. The Smith Barney culture was for the most part, was very collaborative. We thought of the advisors as partners, not employees, and branch managers who ran the branches all over the country. We used to say if you could run a high quality branch at Smith Barney, you could pretty much run any business because you had a lot of autonomy and control over the P&L. But you're right, that became more bureaucratic once you merged it with a bank. And the bank culture was very different than the entrepreneurial culture that existed at Smith Barney. But for me, it was an incredible place to learn the business. I was a young guy in a hurry at Smith Barney, and I had great mentors. The CEO of Smith Barney was a guy who was really beloved in the industry named Tom Matthews, who was a great mentor to me earlier in my career, and another guy named Jerry Ebelhart, who's an investor and on the board of Dynasty now. They allowed me to take on very senior responsibility at a young age, probably in some cases even before I was ready for it. But throw someone in the deep end, right? It's they either learn how to swim or they don't. And I was running private wealth, the ultra high net worth initiative at Smith Barney and Citigroup. I think when I was like 28 years old, I was running the corporate executive initiative for the whole restricted stock business, helping to strategize on how we would bring together the institutional business through investment banking and stock plan and the corporate initiative with private wealth to cover the executives on the wealth side, doing that maybe when I was 30 years old. Again, they gave me great opportunity. I moved around the country, opening various offices for the business. And what I really loved doing was being with advisors and their clients and prospects which is really in our industry, as well as a lot of industries, but certainly in ours, where the magic happens is where the rubber meets the road with the client and advisor connection. And I always thought I want to stay close to that and don't get pulled into the ivory tower, where things are packaged and delivered for you. I'm a leader who likes to lead from the front line. Really, what I took away from that experience was that more and more, and I don't have to tell you this, Joe, you know it well, the family office movement has become more and more democratized, and more consumers ultimately are looking to get their advice in as unconflicted way as possible. So what's happening in our industry is there's a separation between where advice is given from where products are manufactured and sold. If you think about a family office, the advice model is triangulated. You have advice separate from safe custody, which is counterparty risk in terms of where you want your assets to sit. And then you can go out and shop the street because you have significant buying power and the ability to shop multiple asset managers, insurance providers, loan providers, whatever it might be. But for your average American who has a few $100,000, they typically have an advisor who works for the custodian and the product manufacturer in the same silo. And there's a bit more conflict, let's say, in that scenario. And I grew up very modest means, actually homeless for a while, as you and I have talked about, in the sticks of Maine, and really self-taught. And after meeting with quite a number of family offices, hundreds of them, and families behind the family offices, I thought it would be great if we could develop a model in the independent wealth space that delivered the family office triangulation of advice construct to more Americans at a really important time, I think, for our country, where unfortunately financial wellness, financial health of our country, whether you talk about deficits, you talk about the federal or various state level pension funds, some of which are teetering in terms of their ability to continue for future generations, to individuals, where you look at the stats now, 76% of Americans can't put their hand on $1,000 in an emergency, right? Which means they're one leaky roof or a broken down car away from a personal financial emergency. And I just looked at that and said, look, the way that we help chip away to solve some of these issues is not by selling people products that they don't necessarily need. It's really around financial literacy. It's advice that is separate from the product manufacturing component. So that was really kind of the founding principle behind Dynasty, which is to drive the democratization of the family office model to more Americans. And we launched the business. I left Citi in '08, April of '08. Got lucky in that I sold most of my stock in the low 30s on the way to sub $1, and went on a journey for over 2.5 years, building the capital, assembling the team. And it took a while to educate the industry that this new model was here to stay and that we were an integrated platform that could allow advisors to get all the integrated technology, product and services they need, capital to launch their business all in one place. But over the last 15 years, it's really started to take off. I'd like to think we're in our hockey stick moment now, Joe, in that we are, by the end of this year, I think we'll be close to 150 billion of assets on the platform, north of 500 advisors. They're working out of 60 locations around the country. We've literally created billions of dollars of wealth for our team, the advisors that we support. For me, it's very much the early innings because it's what consumers want. It's what advisors want. It's what their staff wants. Whether you're an asset manager or a wealth tech company, everyone right now is focusing on how they take advantage of the movement towards the RIA space because it's a one-way street. Advisors are going independent, and once they do, they literally don't go back. So advisors and clients are looking for that family office model, which again, you know really well, and I think can understand well why that is appealing to consumers at all levels.
Before we talk about the early years, can you give us some idea of what was the technology like in 2008? If you wanted to put together an RIA in 2005, what would you have to do?
Yeah, it's a really great question. So I went on a listening tour. I learned firsthand what that technology looked like by going around and talking to a lot of advisors and really getting a sense of what their experience was back in 2008. And what it would look like is you'd walk into an advisor's office and they'd have 6 different screens up and they'd be toggling back and forth between all the different technology. They would be incredibly frustrated because they'd have to re-enter the same client data 5 different times, and a financial planning application and a proposal generation, the trading system in the CRM. Then it doesn't talk to their email. And it was just very convoluted, very inefficient. And quite simply, I think we've done a number of things reasonably well, but something I think we've done really well is our investment from the early days with our company in data, really understanding that advisors and clients want simplicity. They want integration. Obviously, they want protection of that data. We have built, bias when I say this, but I think the best advisor desktop in the industry because we've invested heavily in our data lake. And that allows us to push data into the desktop around the business analytics. So helping the advisors do budgeting and planning and seeing on a daily, weekly, monthly, and quarterly basis how their business is doing versus goal. A lot of these firms are large, so they have multiple advisors. So being able to see the data broken up amongst the different advisors is really important as well. Also, all of their client data, being able to have a client coming in this afternoon, I can press a button and get a full executive summary of that client relationship over time, inclusive of the portfolio, the last financial plan. It just makes it easier for the advisors to cover more clients, which again is part of our why. Right? We want advisors of integrity to be able to help more clients. In the way that we assist on that is to tech enable all aspects of the business so they can service and help more people as they grow and scale the business over time. And then the third, so you look at client connectivity, business analytics, obviously then the third component of wealth tech is investment management, and not just access to the product, which is important, but how the managers are traded and integrated, the paperwork gets onboarded. It could take 15 years ago, it could take weeks to get an account opened, to get a manager selected, hired, pulled up onto the platform. And then you might have to have you want 5 different managers, you have 5 different accounts. Reporting could be messy, good old Excel spreadsheets and all the efficiencies around that, right? We've pulled it all together into one unified tech stack that has quite a number of proprietary APIs that we use as the pipes to connect reporting systems, compliance systems, custodians, asset managers, financial planning systems. So our advisors don't have to toggle around. They don't have to re-enter the data. They have a digital account opening process all the way through advisory agreements, manager agreements, custodial agreements. It's how we literally will do large multi-billion-dollar advisor moves where there are thousands, in some cases, tens of thousands of accounts. And we're able to do it in a matter of weeks because of our digital account opening and onboarding capability. So that's what the experience looked like back then. It's evolved a lot. The other thing, when you invest in the data infrastructure like we have, it allows us to execute part of our strategy from a tech standpoint, Joe, is bots over bodies. We have bodies that are managing lots of bots, and it's created a lot of efficiencies for our business. And some of those bots we turn into avatars who have their own personalities and can be client interface. Market commentary, as an example, we'll have avatars that can sit on top of the data in the data lake and personalize a message to thousands of clients at a time to deliver weekly or monthly market commentary, which imagine the efficiencies for an advisor that creates so that they can enter in their market commentary, which they can just record, like the conversation we're having. It'll package it up, the bot, and then the avatar delivers it out to their clients at scale. So they don't have to, at the end of the week, have hundreds of phone calls with their clients and keeping them posted on what's going on in the market. That seems like a relatively simple example. It's actually not simple to pull off, but we've been able to build tools like that that puts a lot of scale and efficiency in the advisory businesses that we support which has allowed them to grow on a disproportionate basis relative to their peers.
What was raising capital like? How did you meet Harvey Golub, and how did you get him and people like Bill Donaldson to buy in?
What was it like? I can tell you. So I was 32 years old, right? So I'm a young kid who is hick from the sticks of Maine, as I mentioned, that had spent a decade on Wall Street out there telling investors in the middle of the financial crisis that we're going to change for the better a 200-plus-year-old industry, right? And as Steve Jobs famously would say, the people were crazy enough to think they can change the world. They're usually the ones that do. And you can't sit around and think about the odds because then you'd never do it. But in hindsight, I do chuckle from time to time thinking about that experience because statistically, the probability of pulling it off was quite low. But like a lot of entrepreneurs, when your why is clear and you have great support from family and spouses, and we went all in. So we went 2 years, 7 months, and 4 days without a paycheck. I know because my wife, Marianne, kept track. And she was ready for us to launch the business. So it was hard, right? No one was looking to make an illiquid investment going into the latter part of 2008 and into 2009. I did not want to take private equity money early. I wanted the equity line model, which is raise a little bit, execute, raise a little bit more, execute, rinse and repeat, was more the construct that we wanted to pursue. And I had become friends with Todd Thompson, who was the CFO of Citi. He was the chairman of the wealth business. I worked for Todd and with Todd back at Smith Barney. And Todd was thinking about doing something in and around the independent wealth space as well. So we're comparing notes and decided that we would partner up. And Todd was in the incubator at Ripplewood at the time, obviously probably a reasonably well-known private equity firm to your listeners. And Harvey Golub was on the board or maybe even chairman at the time. And so he'd got to know Harvey through that experience. And Harvey and Todd's very close with Sandy Weil. And Harvey actually had advised Sandy back on the merger. Harvey was at McKinsey before American Express. So there was a lot of connectivity and people that we knew in common. And before Harvey, by the way, I met with 50 other people who said no, just like a lot of entrepreneurs living Shark Tank in real time. So Harvey came on board, really saw the opportunity for disruption in our model, believed in the opportunity to improve financial wellness, and just that the model of allowing advisors to own and operate their own business and work only for their client. There's a lot of confusion in our space about what it means to be an independent advisor. And for me, it's quite simple. If you can only be fired by your client, then you're independent. If you can be fired by someone else, then you're not. But through Harvey, we then met Bill Donaldson. Bill, unfortunately, has passed recently, but Bill, founder of DLJ and former chairman of the SEC, the New York Stock Exchange, somehow in his spare time helped found the business school at Yale. One of these incredible resumes, just a great person too. So Bill was a founding investor and board member. The Glick family out of New York, which a reasonably well-known family office, global real estate investors, actually over the last century have been really successful investors in the diamond industry, as well as quite a number of other operating businesses. They do a lot of partnering with large scale private equity sponsors as well. But Sam Levinson, who runs the family office, who is just this rare combination of off the charts IQ and EQ, came in early on as an investor. And actually Sam and Harvey, we've done 6 rounds now as we've grown the business. They've helped underwrite and invest in all of those rounds, including along the way, we've added institutional investors. And you know how, to your question, when you need capital, it's harder to get it. When you don't, everyone wants to give it to you. But more recently, we brought on board the largest custodian in the industry, which is obviously Schwab. They invested in the business the last couple rounds. And I've known Chuck over the years and Walt Bettinger, who runs the business, Rick Worcester, now the CEO, who took over for Walt. It's great. Rob Capito is an old friend at BlackRock. So BlackRock, the world's largest asset manager, obviously. They've invested now in the business. The largest bank, run by another old Smith Barney guy, JP Morgan and Jamie Dimon. They have invested in the business as well. So we have, I think, the right institutional backing, business cash flows quite well. We have a fortress balance sheet, no debt. but it really started from the early days with Harvey and Todd and Sam and just incredible investors believing in the vision. And like a lot of entrepreneurs that are probably listening to this, it was really hard early on in terms of getting early adoption. But once that flywheel started to spin, it really started to go. And we moved to Florida 6 years ago. And it took us the first 10, 11 years to get to 50, 60 billion. And then in less than half that time, we've accelerated to, like I said, I think we end the year at close to 150 billion with a pipeline that's massive, where we just had a company offsite. We talked about our path to 500 billion and then what we need to do post that to get to a trillion. And we're way out front as the leading integrated platform provider in the space. The macro demographic trend is super to where we sit in the ecosystem, head down and focus on execution from here.
So I'm interviewing Lawrence Calcano next at iCapital. I'm going to ask him the same question that I'll ask you, because you both were technological entrepreneurs. Is why didn't Schwab or Goldman build this business?
Yeah, first of all, I would say Lawrence is a good friend. We've been business partners for a long time, almost probably 15 years. So I'm glad that you're interviewing him, and I'm looking forward to listening to that conversation. I think that if you think about the wealth management business, you can look at there's three verticals that come together to make it possible, if you will. The first is the front office, which is where the advisor interacts with the end client. And then obviously you have the back office, which is the custodian, the record keeping, and the safekeeping of assets. And then that middle office is really where Dynasty lives. And that is where an advisor would wake up and say, okay, I'm going to go juggle 60 different vendor balls and cobble all this together and try to figure out how to do this on my own. Or I'm going to hire a general contractor called Dynasty, who's going to build it all for me, has done it countless times before, and will tie together that front and back office in a very seamless way. When Schwab, who really invented the RIA custody business, got into the business, it was really for, in the early days, certainly smaller advisors. And it was just basically a legal agreement, similar to a family office, that allowed someone who wasn't the family to call on behalf of the family and conduct business. And that little cottage industry, having someone have trading authority or the ability to conduct business on behalf of a family, grew into the independent advisory business. And the evolution of the middle office really didn't start until maybe around the founding of Dynasty. The last 15 to 20 years, there's been a few other tech firms that have tried it, but most of the technology that has been built in the ecosystem has been built for a home office of an enterprise client. It's been built for the home office of Morgan Stanley or Goldman or LPL or Raymond James or whoever it might be. We entered the space and said, we're going to build technology for a business owner who happens to be an advisor. It's a fundamental different approach specific to the RIA space, because it came out of all that listening tour that I was on, even before I left Citi, listening to the consumer in terms of what it is they wanted, which led me to have a high level of conviction that this RIA movement was only going to accelerate over time. And now it's the point where there's more assets on the independent wealth side within wealth in this country than there is on the bank and brokerage side. We've crossed over several $100 billion a year are going one way to the independent side. And it's now happened for enough years in a row that there's more assets that are there. It's just, they are starting, the space is a little bit of co-opetition, if you will. People are starting to move around different swim lanes, but it's hard. If your DNA and experience is in one of those verticals, it's hard to jump around and be best in class in all of them. I do think, though, as the closer you are to the front office, the less margin pressure there is. And obviously, the closer you are to the back office, the more you have to scale quickly because you have more margin compression and pressure that's there. So I think what you're starting to see is the back office starting to move into the middle office. There's some pressure on the middle office to move both back and front. And there's a merging of the lines that is starting to happen. And firms like Goldman Sachs getting into REA custody and providing product and services into the growing REA space. And I think you're going to continue to see more entrants. You're seeing more and more entrants from an investment perspective. We run at one of the top investment banks in the REA space. I can tell you valuations at an all-time high for REAs because they're growing businesses. It's an essential business and industry. It's annuitized revenue. It's predictability of cash flow on these businesses. So it's definitely been discovered. And I think we're very much in the early innings. So whether tomorrow some of the big players in the space decide to wake up and try to innovate their model, play more in the asset management space, move more into the wealth tech vertical, decide that they want to invest. You just saw this with LPL announcing that they're looking at wanting to make investments in some of the OSJs and advisors on their platform. I'm sure that they can make good investments there, but part of it's not just offense, it's defense, right? They don't want an advisor to sell away to private equity or some other firm if they could buy a piece or buy the business and have them stay a little bit more captive. So I think we've entered the era of innovation in an accelerated way. Obviously, AI is going to shake free in the innovation around blockchain technology and the impact that could have with custodians. There's going to be a lot of change over the next 5+ years, but I think you're going to see people jump around swim lanes quite a bit.
What is the decision like for these breakaway teams? Why do some people stay? Why do some people leave? How much do you need to leave? And how much capital do you need to safely leave the mother firm?
We tend to work with firms that are 3, 4, 500 million and above. The average firm on our platform is a couple billion. Sometimes advisors don't call us, so I'm really careful about this because they'll think that maybe they're too small. But to your question, for us, from a revenue standpoint, most of our firms are 2.5 million or more in revenue. We have some firms that do over 100 million in revenue, right? So it runs the gamut. But typically, and to your question on what is someone thinking about when they look to make a move, I will tell you our number one competition by far is inertia. And when somebody comes to St. Pete, which are headquarters, for a home office visit, we call them a VIP meeting, coming in and personalizing our platform and learning about what the process would be. But 50% of the time, they sign up with us and they make the move. So then you'd say, okay, what happens the other 50% of the time? They do nothing. So it's rare that someone would come and spend a couple of days with us and then make a move and not do it with us or try to do it on their own. Because the Dynasty Delta at our size and scale, we actually can help them run a more efficient business than they can do on their own. And we free up their time to grow. So they're growing quicker. But more specifically, the larger teams that are doing 5 million plus in revenue, on average, are going to be 50 or low 50% payout at a brokerage firm. On our platform, those advisors would have gross income in the mid to high 60s. So you're looking at somewhere in the 20, 25, and all the way up to as much as 50% enhanced cash flow with less bureaucracy, modern technology that's built specifically for how you want to service your clients, which results typically in happier employees. Their clients get more choice, plus modern technology in terms of apps and how they interact with their advisor. And then rather than being captive to the products of their previous employer, they now have $150 billion, right, backed by Dynasty, of buying power to go out and shop the whole industry on behalf of their clients. So it's one of those moments where the alignment is just so pure in terms it's better for the advisors, it's better for the employees, better for the client. And the advisor just needs to have the courage to know that their clients will follow them and to do the work. It's 3 or 4 months of work in preparation. We have to find the real estate, negotiate the lease. We design their name, their branding, their logo. It's a fun process. We build their website, get all their documentation ready to go.
How does that actually work? Do they have to come to you? Do you have a forward deployed team or something?
Yes, we do. We have a very robust transition team that deploys out for weeks and months in advance, where we're doing all the project planning, the art of war, right? The battle is won before the first shot is taken. And when we're comfortable and they're comfortable that all the preparation has been done, then we go ahead and start the transition. A lot of clients, and actually just had dinner and drinks with a number of couples with my wife last weekend, and we were talking about broker protocol and what it's like for an advisor to move from one firm to another. And they almost were, what I would say, Joe, getting angry. They're like, wait a minute, I've been working with my advisor at pick a firm for 20 years. You're telling me that if that advisor thought that what's in my best interest would be to go start his own firm, that his current employer would take the stance that they own the relationship with me, even though I've never met anyone at his firm ever other than him and his team. I'm like, yeah, exactly. They take the stance that they own the book, and they get aggressive with trying to go after the client. And so a lot of clients don't realize the pressure that the advisor is under in that type of scenario, and the fear sometimes that prevents them ultimately from having the courage to make the move, even though they know they'll make more money, they'll own their business. So from a enterprise standpoint, these businesses will be much more valuable once they move. Their employees will be happier, clients will have more choice, but their current employer is scaring them by saying, if you try to make this move, that we might take legal action, or we're going to dole out the accounts and have other advisors be aggressive and go after it. These are very competitive situations sometimes, which is why our planning and expertise and ability to move swiftly and moving the business over for someone starting a new business is so important.
How does the growth of these mega RIAs affect the need for talent, for the fact these firms need staffing? Folks who are thinking about leaving firms, maybe they'd go to one of these monsters. How do you think that's changed?
Yeah, no, it's interesting. I was talking to another advisor recently, and he was talking about some of the wealth that's been created working at some of the big banks. And there are some big teams there, but the advisors that are in some cases worth hundreds of millions, or the billionaire advisors, are all on the independent side, who own and operate their own business. And it's just created significant wealth for quite a number of entrepreneurs who built large businesses. Usually the way that they do that is putting in place aggressive organic growth plans, but also inorganic growth alongside of it. And if you think about the ability to go out and buy smaller advisors who might have a few hundred million, where you might pay 7, 8, 9, maybe a 10 multiple of EBITDA. The large firms right now in the space, Joe, are trading, if most of their revenues annuitized and they have reasonable 10% plus growth, we're seeing multiples north of 20. The ability to create further wealth and enterprise value through inorganic growth is substantial. There's no shortage of capital if the advisory firms want a capital partner to support them in doing that. So I think we're very much in the early innings of these mega firms being produced. We want Dynasty, which I see us as that Intel sticker that's powering the larger firms. We want to pick some winners in different geographies around the country and pour the proverbial gas on the fire to help them grow. And the larger they become, the more brand relevance, obviously, they have in their market, the more capital they have to deploy for marketing campaigns. And I will tell you, with this breakaway trend, we get hundreds of advisors contacting us every quarter, wanting to learn about benefits of independence and making a move. And I would tell you, probably now more than half of them aren't calling to launch their own farm. They're calling to learn about the benefits of independence for them and their clients, but then they want to join. So they want to break away and join a large RIA where there is a CEO and leadership team already in place, so that they can focus on taking care of their clients. To your question, the rapid professionalization over the last decade in the RIA space is incredibly impressive. You have advisors who are becoming CEOs, and we actually have a program that we run with various business schools around the country, Advisor to CEO. It's an educational program designed to help people make that evolution. But I'll tell you, there's a lot of business that we support where the CEO was never an advisor. They're professional leaders and managers that see the opportunity for ownership in the business as tremendous wealth creation opportunity by owning equity, running the business, let the advisors do what they do best, and then monetizing that business at some point down the road.
So you folks recently have gotten into M&A advisory. I'm curious why you got into that business and what you've discovered, maybe some interesting deals that you've worked on.
I think we've done a pretty good job over the years of listening to our clients. So we launched as a wealth tech business, and then our clients said, we want you to launch an investment platform, take advantage of your scale that will benefit all of us and our clients. And then along the way, our clients asked us to build an investment bank because they wanted representation on both the buy and the sell side. And they wanted support in raising capital to take advantage of some of the growth opportunities that we've been discussing here. And more recently, we launched another business called Dynasty Connect, which is about connecting advisors who want to join firms as well as end investors who are looking for an independent advisor to get connected with one as well. But for our business, to your question about investment banking, it obviously gives us great market intelligence to understand what's going on in the space, structural trends, valuation trends, and the like. And it's allowed us to have a really powerful growth engine internally that creates a cause and a reason for advisors who might be looking to execute a succession plan or looking to get matched up with another firm to call us, and then to help our clients more broadly grow inorganically. So that business now is a couple years old. I think last year we were number 2 in the industry in the league tables, and pretty confident we'll be number 1 this year in terms of number of transactions across our network. And we're going to continue to invest heavily in it. And it's very synergistic to our wealth tech, the investment platform business, as well as our leads business.
If you could go back and start all over again, is there anything you'd do differently? Was there any strategic mistakes you might have made or things you'd like to correct?
I think it's in some ways probably similar to other startup entrepreneurs. There's a handful of us that have been fortunate to do it from scratch. In my case, literally from the garage, that you build a unicorn, right? And there's a lot of lessons along the way. From the early days, I probably gave away too much equity in hindsight. Fortunate in that I haven't given up control per se, but I think in the early days, you don't necessarily think about how much equity you're going to need 15 years later. And the people who get you to one level aren't necessarily going to be the ones that get you to the next level. And the management of the cap table. And there's a lot of entrepreneurs forget when you're trying to drive earnings per share, there's a couple ways to do it. One, obviously, is growing the top line. The other is to manage the share count. And I'm proud of the fact that we've created a lot of wealth for a lot of people, but there's a lot of ex-employees or partners early on that I gave a lot of equity to. Probably would have done that a little bit differently, maybe not just time in the chair, but also tied to production within the business back in the early days. I probably, in hindsight, could have done a better job at making the hard decisions quicker. I think my wife would say she can live with this, but people might say I'm loyal to a fault. And when I was in the garage with a business plan, if you were a resource partner, I don't say the term vendor, but if you were a partner of ours helping us in the early days, I've probably hung on to some of those too long because they helped me in the early days. We probably have hung on to team members where the business had outgrown their competency, but we're loyal to people early on. And so the evolution from family business to through adolescence to getting to the point as a leader where you say, look, I'm going to wake up every day from now on, and I'm going to make every decision based on what's in the best interest of the company. And if you do that, at the end of the day, it'll benefit those that it should. And look, I've been a CEO now for 15 years. The first 5 years, you're learning all the time, right? But the first 5 years, you're getting your legs under you and getting the experience. And at 48 now, I think I'm hitting my stride. I have good energy for it. It's my baby. God willing, I can do this another 10 years and feel like we have the right partners, the right team, the right kind of fortress balance sheet, market demographic trends that are our friends, and enough experience and maturity that allows us hopefully to take full advantage of what I think is a once in a lifetime opportunity.
So a question I often ask on this podcast is, do baseball players make better investors?
I would call myself more of an operator than an investor, although I do have some really smart people here who run a great investment business, fortunately. I think any team sport, look, I encourage my daughter, older daughter, our daughter is getting ready to go off and play team tennis, Division I tennis player. Very proud of her. Our younger daughter plays softball. And I think about the early days here. I actually had 4 of my college baseball teammates in the early group at Dynasty. I have several of my other college friends that are still here now. And that camaraderie that you build when it's one team, one dream, and you're all working towards a common goal. Also, to be a college athlete requires a lot of discipline in terms of working on your craft or your sport while also academics and the other parts of life. And a lot of times the trifecta is we find young talent that were great athletes, good students, and had to work a job in college and be able to time manage and be disciplined in all those facets. They usually make a pretty successful team member for us here. And we are a very competitive group, very competitive, but it's not inwardly competitive, it's outwardly competitive. And there's a real culture here of teamwork. Dynasty Financial Partners, the P is really real to us in terms of the partnerships with each other, our clients, our resource partners, as I mentioned. I'm super proud to say, Joe, every person at the company is an equity owner. And a good number of them also wrote checks to buy equity in the business. So they spend money, it's their own because it is. In life, if you can get alignment, the right alignment with the right people, great things can happen. And I do think some of that started in the dugouts on the baseball field with my teammates over the years. So I would say, sure, baseball players make better team sports people, I think, make better operators if they've been successful in a team environment.
Shirl Penney, thank you for joining us and sharing your wonderful insights.
Joe, thanks so much for having me. Really enjoyed it.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.